Bharti Airtel slips following a large trade where nearly 1.3% equity gets exchanged. Sources say Singtel is the likely seller. Another large trade today pushes JSW Infra lower as well. 4.5 crore shares worth nearly 1250 crore rupees change hands. Sources say it's the Sajan Jindal family which is the likely seller.
IndusInd Bank trades under pressure after the bank discloses more irregularities. The Internal Audit Department's report finds 674 crore rupees was incorrectly recorded as interest over 3 quarters of FY25. CLSA downgrades the stock.
Crompton climbs more than 4% after posting good numbers, now up 6%. Revenue comes in line while profit and EBITDA beat analysts' expectations.
Newland Labs slides more than 6% after showing a weak performance for the fourth quarter. Revenue declines 18% sequentially. However, the management says growth will resume in FY26.
In other results reaction, we do have IKS Health and SKF India trading higher on the back of their numbers. In fact, we have the management of both these companies joining us shortly to discuss the quarter gone by. So don't go anywhere. Good morning. You're watching us here on Chartbusters on CNBC-TV18. I'm Mangalam Malu. With me, Vinny Motiwala. We come to you live from the CNBC-TV18 Motilal Oswal studio. And it's been a decent day so far. No real worries. Yes, there has been some decline from the highs, but Nifty is managing to hold on to the 25,000 mark, which it captured yesterday. And the mid-cap index, that's doing a lot better, up nearly 0.8%. And almost 1,800 stocks advancing for 800 stocks, which are declining, telling you your portfolios are looking a lot better. No real problems. After a big rally in the second half of trade yesterday, we are seeing some bit of give back. Again, nothing really to worry ahead of the weekend, Vinny.
Absolutely nothing to worry ahead of the weekend is what we're watching out for. But two sectors that I want to highlight, IT and Pharma. Both these yesterday also were subdued in trading session. Today, also a bit of a red is coming in on the screen for both these sectors. We have the Nifty Realty, which is managing to hold on to good gains among the top sectoral gainer today. So keep an eye out on that. And a whole host of other stocks like GE Shipping that continues to be in focus, as well as BEML also in focus as well.
All right, let's get cracking on the numbers. We had promised to you while we were reading headlines that the management of SKF will be with us, and that's exactly what we have. Up 6% in today's trading session, that stock, because Q4 has historically been a strong quarter for the company in that as well. They've shown margin expansion. Mukund Vasudevan, who is the managing director of the company, joins us now. Thanks a lot, Mr. Vasudevan, for joining in. Congratulations on a good set of operational performance that has come by. I'd just like your thoughts on a couple of things before we, move ahead with what the outlook for the next year looks like. If you could give us a split of the performance in the fourth quarter for both your industrial and automotive segments, and where was the margin expansion more? What was the operational performance of both these verticals like in the fourth quarter?
Great to be here, Mangalam and Vinny. A good performance overall. We expanded our margin by almost 20% this quarter overall, and we grew the top line by 1%. The top line growth hasn't been as strong, but you can't look at one quarter. If you look at the full year, it's 8% growth, and that's pretty consistent with what we have done year on year for the last 5 to 10 years. So in terms of automotive and industrial, the margin expansion has come from both. Both have done very well, and on the back of operational improvements on the manufacturing side, cost controls across the board, and some intercompany benefits we've got, which is from all the imports we're doing from other SKF global factories.
So if you could quantify that, the growth that we saw in the revenue for both auto and industrial, and the kind of margins that we saw year on year?
Yeah, so industrial grew by around 2%, and automotive grew around a little less, so averaging out around 1% top line growth. On margin, industrial grew by almost 25%, whereas automotive grew a bit less, but it's a smaller portion of our business overall, 40% or so. Right. So, and then what was your second question? Sorry, Mangalam?
No, that was all about it.
Yeah. Okay.
Okay, Mr. Vasudevan, good morning. Thank you so much for joining in with us. What I want to also know is in terms of your two-wheeler and three-wheelers, what is the share of premium over here and the outlook that you have on EV adoption for yourself?
EV adoption is growing. It's still slow, meaning it's still small in terms of volume in India, but it is growing. And SKF is very well positioned to satisfy this market because Two-wheelers, as you can imagine, are all about lighter weights. It's all about energy efficiency, and that's the strength of SKF. So our business in EVs is absolutely booming. Two-wheeler market tends to go a little bit to answer your first part of your question, two-wheeler market tends to move up and down a little bit with economy, especially rural. This quarter in particular, our expansion has been primarily in actually passenger vehicles, where SUVs are continuing to boom, and also in smaller commercial vehicles. This is the last mile delivery vehicles, where we see that with the boom of e-commerce and quick delivery, there's more and more demand for smaller commercial vehicles, and that's the two areas we have grown. Two-wheelers have been steady, but it's still it's not the strongest quarter for this year.
All right. And what about the year ahead? You know, you've grown about 8% on top line this year, but operationally, it's been absolutely flat. You've actually lost margins by about 100 basis points from 15.7%. It's gone down to 14.7%. And there has been a marginal growth in the profitability as well, just about 2.6%. Notwithstanding the fourth quarter, which was strong, the entire year wasn't so. What's your outlook for FY26 as we look at it from the start?
No, I think we'll continue to deliver strong profit before tax, right? We typically maintain in the range of around 15 to 18, and we will continue to do that. It's been a record year in terms of absolute profit, but you're right, the margin could have been better, but we can't base it on 1 year. Overall, our trend in profit has been growing at around 13% year-on-year CAGR for the last 5 years. I think we'll continue this trend. We see, barring any kind of major macroeconomic issues, we see this 25, 26 continue to grow in the high single digits or low double-digit numbers, as well as top line, as well as the profit before tax should continue to be in the 16 to 19% range. You know, one major thing which is happening is this year is the separation of a demerger of the automotive and industrial business, which we believe will build two world-class fit-for-purpose companies. I think you'll see margin expansions coming from 27 onwards in these. But this is going to be a major year where we'll see this demerger happen. There will be some headwinds because of that, but irrespective, I think 27 onwards, you'll see margin expansion on both sides.
When will this demerger, actually take place in FY26, first half, second half? When are we expecting that by?
So that is expected in around November timeframe, but obviously it depends on SEBI and CLT approvals.
All right. I just wanted a couple of things on the demerger itself. If you could now give us a sense on the pro forma gross block of both these verticals, the kind of balance sheet that both of them will have in terms of debt or, capex that will be deployed from either of these verticals. And basis that, the compounded growth rate that we can expect on both these verticals over the next 3 to 5 years post-demerger.
A lot of this is being worked out as we speak, Mangalam, so you're kind of jumping the gun here. But I'll tell you that the basic idea is the two businesses are very different, automotive and industrial. Automotive is a lot about, if you take manufacturing, for example, it's large volumes, series production. Industrial tends to be smaller batches and a lot of resetting, which happens in these. Industrial is a lot more varied in terms of different industries we serve. Automotive is a little more linear that way in terms of the two-wheelers, the commercial vehicles, passenger vehicles, etc., right? And EVs. Even the trends which are emerging in both are slightly different. And that's the reason we are doing this demerger, because we believe we can then create an entire value chain from manufacturing to innovation to sales, which is catered specifically to both these entities. Both, we would see a margin expansion because we believe that it will become more efficient and not have one business drive the other or vice versa, right? I think both will become more efficient, so we see margin expansion happening on both. We also see better capital allocation because today, if there was a capital allocation choice, typically because, as you see, profit before tax for industrial tends to be a little higher, the capital allocation tended to go to industrial. So if you had a choice. Now capital allocation will be a little more efficient in this when you have a demerger. And then on the growth front, I think we would expect to see similar growth on both. I would say if we can continue the 10% plus double-digit growth which we have delivered consistently for the last 5 years, it'll be good. I think we can actually see expansion because we can do more innovation specific to industrial and automotive. So I don't have specific numbers as of yet, but I'd say that this is how the trend is going to be.
Okay, Mr. Vasudevan, thank you so much for joining with us on the show this morning, explaining us what to expect from the company going forward. High single-digit to low double-digit revenue growth in FY26 and maintain margins at around 16 to 19% on the PAT level. But on that note, we're going to step into a very short break, viewers. On the other side, we'll be joined by Sachin K. Gupta, who is the founder and CEO of IKS Health, as well as Nithya Balasubramanian, who is the Chief Financial Officer at the company, to discuss the quarter gone by. Welcome back to Chartbusters on CNBC-TV18. Now let's focus and put the spotlight on IKS Health. They reported their numbers, a 17% revenue growth on a year-on-year basis, driven by ramp-up in client additions as well as good margin improvement is what they've seen. Now talk to us about the numbers as well as the outlook of the company going forward. We have Sachin K. Gupta, who is the founder and CEO of the company, as well as Nithya Balasubramanian, the CFO of the company, joining you to talk to us about all of that. Sachin as well as Nithya, thank you so much and good morning to both of y'all. Before we dive into the numbers, just yesterday we had, more updates coming in on United Health, the issue on that front as well. I just want to understand what would be the impact of this on the company, any concerns that we're watching out for in FY26 on this front?
Good morning. First of all, thank you for having us today. Pleasure to be here. So yes, United Healthcare, look, I think obviously it's a company that's going through certain headwinds that are significant. As you know, they've been hit with three pretty dramatic events over the last 12 to 18 months. One of their biggest subsidiaries, Change Healthcare, had a big cybersecurity attack that almost destroyed them. The CEO of their insurance business was assassinated, and then a big part of their business, which is a Medicare Advantage business, is going through headwinds due to what is called HCC version 28. I will say that most other companies, if hit by such perfect storms, one after the other, would have collapsed. Now, keep in mind, United Healthcare is the largest health insurer in the world, certainly in the US, but in the world. They have nearly 50 million plus lives under insurance. So is the company under pressure? Yes. But is the company losing money? No. Is the company, does it need to transform certain things? Yes. Now, our relationship with United Healthcare is orchestrated through one of this $110 billion revenue company subsidiary called Optum Health, which employs 50,000 plus physicians. It's the largest employer of physicians in the world. And as you know, our business model is all built around driving operating efficiency in the non-discretionary spend for these physician businesses in the US. So in fact, what happens is when our customers come under pressure, we actually become often the relief valve that they need to get their performance where it needs to be. A testament to that has been that our relationship with United Healthcare has really grown at least 20 to 30% over the last 12 to 18 months. So actually, as much as it is unfortunate what United Healthcare is going through, I think there is no existential crisis to the business. And as they try to do things to get the financial performance of the business where it has been historically, we actually will be one of those contributors, we believe. And hence, without trying to get too speculative, I think we should be okay from a United Healthcare perspective. And I think United Healthcare as a business should be okay in the medium to long term.
Should be okay in the medium to long term, but how much of our revenue or any sort of impact that you could give us, how much revenue comes in from United Healthcare side right now?
Yeah, so we don't tend to reveal that, but suffice to say they are one of our largest customers. And again, really important to note that our revenue with them has been growing through this period of crisis. And actually, when we look at our opportunity set with them, it continues to reflect continued growth because it's very important to draw the distinction that a lot of what traditional IT services companies do with them is on the discretionary spend side. And in such crisis, discretionary spend gets cut. Whereas what we do with them is all non-discretionary operating spend, which we actually improve the cost on. And hence, our relationship with them in a tough situation is likely to experience growth versus deacceleration.
What I'm trying to understand is that, United Healthcare, which you're not revealing how much it contributes to your overall revenue. I see top 5 clients contributing about 22% to your revenue. Would suffice to say they're part of your top 5?
Absolutely.
Got it. Nitya, Sachin did mention that regulation in healthcare will be your friend. Now that some regulatory announcements are beginning to come through, do you still hold that belief? What exactly is happening here? Because, day in, day out, you get headlines on social media, the President of the United States just putting out posts, changing, flipping, flopping. How do you navigate through that?
Specifics are still emerging, but I think if you look at it more from a fundamental perspective, what they're trying to achieve is reduction in healthcare costs. You'll actually note that healthcare spend in the US is $4.8 trillion, growing faster than GDP. So clearly they have to do something about making it a lot more sustainable in the future. So we believe that we are actually part of the solution. What we bring to the table are efficiencies and a platform through which these healthcare provider organizations can actually run their operations a lot more efficiently. So we genuinely believe that whatever be the specifics of the initiatives that the administration takes, given that the fundamental intent here is to make healthcare a lot more efficient, we continue to believe that this will be a tailwind given how our business model is structured.
So in light of that, with the kind of year that you've had, earlier it was alluded to as a perfect storm of sorts, you've still managed to grow 17% this quarter. For the entire year, it's been a much larger growth. As your base increases, what do you think would be a steady state growth that one should estimate for a company like yours over the next, say, 1 year, 3 years and 5 years? Nitya?
I think we have always maintained, and I will continue to maintain our guidance that we will, in the long run, be able to grow faster than the market. If you look at our addressable market, that's about $225 billion, expanding at 12%. And if you look at the underlying healthcare market, that's about $4.8 trillion, expanding at 5 to 6%. So we continue to believe that we will be able to grow faster than the market. Out of the TAM of $225 billion, only $34 billion is outsourced today. So there is clearly a lot of growth runway left. And given our business model, given our investments in technology, we will continue to grow faster than the 12%.
Okay, you will grow faster than the 12%. I just want to check in terms of the margins as well, right? Previously, we had spoken about the 30% range in terms of EBITDA margins. In Q4 FY25, we're clearly above that mark. Though full year FY25, it's 29% approximately. I want to know the outlook for margins in FY26. Are we going to be doing better than 30%? Would you increase your guidance for FY26?
Don't give guidance deliberately given the relative maturity, but we have been vocal in saying that we believe our margins will eventually stabilize somewhere in the early to mid 30s. And our 31.2% EBITDA that was delivered in Q4 FY25 is a fine reflection of our confidence in our ability to get there. So I feel like we have every reason to believe that we will get to that early to mid 30s range over the next 12 to 18 months. And without giving formal guidance, we continue to believe that that seems imminent.
And what kind of client wins are you expecting this year? You had 2 big ones last year. You didn't quantify the size, but if you could give us a sense of, the client wins that you're targeting this year, maybe potential size, because it's an interesting influx of both pharma and IT. Typically, IT companies give us these details.
Yeah, so, Mangalam, there is a deliberate reason why we haven't been giving the specifics, because the way our business works is often clients commit to a large contract, but the ramp up of the contract happens over a period of time. And different clients have different ramp up periods depending on which features of our platform they're implementing. And so what we tend to do is we announce clients that are full platform commitments. For example, this quarter, we have 3 customers that are full platform commitments. Skylakes is a big health system that's a full platform commitment. Platinum Derm is a full platinum commitment, which is one of the world's largest dermatology platforms. And a Western Washington Medical Group, a multi-specialty group, is a full platform commitment. Now, those tend to be larger in size because we are naturally committed to getting the full share of their wallet for those tasks. And then there are other customers that might be even larger in size, but they're committing to certain features of the platform. So suffice to say that, given where the buying behavior is and where it is still dynamic and not mature, it's hard for us to hazard exactly what the client revenue will be in 3, 6, 9, 12 months from now, which is why we continue to say, Mangala, my simple thinking is if the outsourced TAM is growing at 12%, if we grow faster than 12%, we are gaining market share. If we grow slower than 12%, we are losing market share. We feel confident based on our leadership that we will continue to gain market share, hence that faster than 12%. If the outsourced TAM starts growing at 15%, my suspicion is we'll grow faster than 15% as well. But how much faster than 12% becomes a little hard to predict in this currently dynamic buying deal.
Okay, Sachin, as well as Nithya, thank you so much for joining in with us on the show and giving us your time, explaining us what to watch out for on FY26 from the company. It's a pleasure having you both here. But on that note, we're going to shift focus now to a special segment where we will get you a few ideas of profit from Money Control Pro. Bharat Jianani is joining in with us of moneycontrol.com to give us and talk to us about a stock that he's been tracking closely. Bharat?
This area has been trending. The company posted better than expected margin performance in Q4. Despite slow level like-for-like growth moderating to single digits, the company was able to improve its margins. Better store operating matrices as well as operating leverage let the company post better margins. We expect the company to continue rapid store expansion for both Westside and Ruby. In metro and tier 1 cities and towns, the strategy is to deepen presence, whereas the company would enter new locations in tier 2 and 3 cities and towns. Emerging categories of innerwear, beauty and personal care, footwear are driving store level sales. Recent foray into lab-grown diamonds is expected to drive the store level sales further. The company's loyal customer base is increasing, with Westside Club members reaching 16 million in FY25. Increased Westside.com sales as well as the parent support in the form of Neo app is enabling the company to scale up its digital business. At the current market price, the stock is trading at a PE of 64 times FY27 core fashion business earnings. Investors with a long-term view can add this stock in the book.
Right, Bharat, thanks a lot for that. A bunch of stocks moving around. Titagarh Rail Systems, that's the one on fire, up nearly 8%. We did see some traction in rail-related stocks over the last couple of trading sessions. This one comes back as well. The weekly gains on this stock would mirror any of the defense names as well, up 27% on Titagarh Rail Systems. Take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay with us. Welcome back. We're talking about Titagarh Rail Systems. Look at IRFC. That's the one which is surging as well. Hindustan Aeronautics up 13% this week. Angel One is the other one which is up around 13% as well. But the one which is taking the cake is about 5% higher. That's Apollo Tyres. Sudarshan joins in with the key takeaways of what the management had to say in the conference call for the fourth quarter of the company. Despite a minor miss on the numbers, the stock actually is surging. Sudarshan.
So the stock is today one of the top mid-cap gainers, and company in Q4 FY25 had underperformed peers, and as far as on the results, it had missed. It was a minor miss to the estimates. But now the commentary is coming from the analyst call, and those commentaries looking very positive. For Q1, company is saying that two segments where it had seen a decline, those segments are OEM and exports. Both these segments will see a growth in Q1, and going forward, it believes that growth will be in double digit, and also the situation has been improving as far as the Europe is concerned. Also, question was asked related to the tariff impact, and company believes that even if there would be any impact, it would be very marginal. So overall, it's looking positive from the con call of Apollo Tyres.
Okay, thank you so much for that, Sudarshan. But with that, we're going to wind down this edition of Chartbusters on CNBC-TV18. Thank you so much for tuning in. But here's some good news coming in for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, as well as financial world updates at your fingertips. Download the CNBC-TV18 app from the Apple Store or the Google Play Store, or you can just scan the QR code on the screen.